Welcome to my channel, Wealth Ledger.
When you're a student, life is full of challenges, managing classes, exams, part-time jobs, and often living on a very tight budget. With so much going on, the idea of investing might seem like something you can postpone until you're older or earning more money. But here's the truth. The earlier you start investing, even with small amounts, the bigger advantage you have over almost everyone else. In this video, we'll break down the essentials of investing for students in a way that's simple, practical, and designed to help you start building wealth even before you graduate. Let's start with the most important principle. Time is your greatest asset. You may not have a lot of money as a student, but what you do have is time. Thanks to the power of compound interest, even small investments made in your late teens or early 20s can grow into significant amounts by the time you're older. For example, if you invest just $50 a month starting at age 20, and you earn an average return of 7% per year, you could end up with over $120,000 by the time you're 50. Wait just 10 years to start, and the same investment only grows to about $60,000. That's the power of starting early. It's not about how much money you invest, but how much time your money has to grow. Now, before you invest a single dollar, you need to make sure you're financially ready. The first step is building an emergency fund. Life is unpredictable, and as a student, unexpected expenses, like car repairs, medical bills, or sudden travel costs, can throw you off balance. Aim to save at least $500 to $1,000 in a savings account before you begin investing. This fund acts as your safety net, ensuring you don't have to pull money out of your investments at the wrong time. Once you've got that cushion, the next step is understanding the basics of investing. Think of investing as putting your money to work so that it makes more money. There are several ways to invest, but for students, the best approach is usually to keep things simple, affordable, and low risk. The three most common investment vehicles for beginners are stocks, bonds, and funds. Stocks are pieces of ownership in a company. When you buy a stock, you essentially own a small part of that business. If the company grows, your stock value goes up, and sometimes you'll earn dividends. Bonds are like loans you give to governments or corporations. They pay you back with interest over time. Funds, such as mutual funds or exchange-traded funds, ETFs, are baskets of stocks or bonds that you can buy into, giving you instant diversification without having to pick individual companies. For students, ETFs are usually the smartest option. Why? Because they're low cost, easy to understand, and spread out your risk. For example, instead of trying to buy shares of Apple, Tesla, Amazon, and dozens of other companies individually, you can simply buy an ETF that includes all of them in one package. This way, if one company struggles, your investment isn't wiped out, it's balanced by the success of the others. Another crucial concept to understand is risk versus reward. Higher risk investments, like individual stocks or cryptocurrencies, can sometimes give you big rewards, but they can also cause big losses. Lower risk investments, like bonds or index funds, grow more steadily but with smaller returns. As a student, your goal isn't to get rich overnight, it's to build good habits and start growing wealth steadily over time. Remember, consistency beats intensity when it comes to investing. Now let's talk about practical steps to get started. The good news is that investing has never been more accessible. Thanks to apps and online platforms like Robinhood, Acorns, Fidelity, and Vanguard, you can start investing with as little as $5 or $10. Many of these platforms even allow fractional shares, meaning you don't need thousands of dollars to own part of Amazon or Tesla. You can buy a small fraction of the stock. So, what should a student actually invest in? Here's a simple strategy. Focus on low-cost index funds or ETFs that track the overall market, like the S&P 500. These give you exposure to hundreds of companies at once, reducing your risk. If you want to be a little more aggressive, you can add a small portion of growth stocks, companies you believe will perform well in the long run. For extra diversification, consider putting a small percentage into bonds or bond funds, which provide stability. A great starter portfolio for a student might look like this: 80% in a broad market ETF, 10% in bonds, and 10% in cash savings or safer investments. This way, you get growth potential while still having some stability. Another smart move is automating your investments. Just like you'd set up autopay for bills, you can set up automatic transfers into your investment account. Even if it's just $20 a month, the consistency builds a habit and ensures you're taking advantage of dollar cost averaging, buying investments regularly regardless of whether the market is up or down. Over time, this strategy helps smooth out volatility. Now, let's address a common fear among students. What if I lose money? Yes, investing always carries some risk, but here's what you need to know. The stock market goes up and down in the short term, but historically, over decades, it has always gone up. If you're investing for the long term, short-term dips shouldn't scare you. In fact, market downturns are opportunities to buy investments at a discount. As long as you stay consistent and avoid panic selling, your investments will grow over time. Let's also touch on mistakes to avoid. First, don't chase get-rich-quick schemes, hot stock tips, or meme stocks you see trending online. These are highly speculative and can lead to big losses. Second, don't invest money you'll need in the next year or two. Investments are for long-term goals, not short-term expenses like tuition or rent. Third, don't forget about fees. Always choose low-cost funds, because high fees eat into your returns over time. As a student, you also need to think about your financial priorities. Investing is important, but it shouldn't come at the expense of paying off high-interest debt. If you have credit card debt charging 20% interest, pay that off before you invest, because the guaranteed return of paying down debt is better than any stock market gain. Similarly, make sure your essential expenses, like food, housing, and textbooks, are covered first. Investing is about building wealth steadily, not putting yourself in financial danger. Another question students often ask is, how much should I invest? The answer depends on your situation. If you're working part-time or living on a limited budget, start small. Even $10 or $20 a month is enough to build the habit. As your income grows after graduation, you can increase the amount. The key is not the amount you start with, but the fact that you start early. Finally, let's look at the mindset. Investing isn't just about making money, it's about building discipline, patience, and a long-term perspective. When you start investing as a student, you're not only giving yourself a financial head start, but you're also training yourself to think ahead, to resist impulsive spending, and to prioritize future stability over short-term gratification. These are life skills that will serve you in every area of life, not just finance. In conclusion, investing for students doesn't have to be complicated. Start with the basics. Build an emergency fund, learn the difference between stocks, bonds, and funds, and choose simple, low-cost investments. Begin with small amounts, stay consistent, and remember that time is your greatest advantage. You don't need to be a finance expert to succeed, you just need to take the first step. So, whether you're 18 or 22, the best time to start investing is now. Your future self will thank you.
Thanks for watching video. Please share with friends. Subscribe, bell icon, and share.